Over the past weeks, geopolitical noise around Venezuela has picked up, with bold statements coming out of the US and renewed questions about who will ultimately control that massive oil potential. For investors, the core question is simple: does this actually change Exxon's long term story? In this video, we separate facts from noise, break down Exxon's fundamentals, and look at whether the current valuation already reflects these geopolitical risks or not. Welcome to another video. My name is Robin, and as per usual, I'm joined by Kirill. And before we dive into it, Happy New Year. Sorry we've been away for a bit. We had some pleasantries with Santa Claus and everything that we needed to get sorted first. So we took a little time off. And also, we have some really nice things to show you that we have been working on since we've been gone. But today, fear not, we have a new video and of course a valuation video for you guys. So if this is your first time, or if this is not your first time watching, but you still want to know what we're going to cover, we're going to cover what's in the news. We're going to go over the company fundamentals. And finally, of course, the value that you're going to get out of this video, the company valuation of Exxon Mobil stock. But guys, this is not, of course, financial advice. As we always say, do your own due diligence. This should be your starting point of this journey. Kirill, what's in the news?
I'm not even going to say anything. I'm just going to show you guys this.
A mess. The country is a mess. It's been horribly run. The oil is just flowing at a very low level, much lower than, even if it was badly run, it should have more income, more oil than what they do. So we're going to have the big oil companies go in, and they're going to fix the infrastructure, and they're going to invest money.
So yeah, drill baby drill is really happening, not only in the US, I guess. So
yeah,
all sorts of fun.
Yeah, exactly. With the ever-building presence of the forces in that area of the world the past months, probably did not come as a surprise. Maybe how fast it happened and at the timing of these events, but of course, really weird way to start off 2026, and it did also have a huge impact on the oil prices. Trump, of course, also stating that it's just also his oil that he's gonna take back. And you can also switch to that article. As he has not really a point to say, but there were some Exxon Mobil involved in 2008 or 2007, and then the previous president Chavez basically nationalized the oil companies and also included Exxon, where they had to give over their production to Venezuela, and that's also what Trump is mentioning. But we are here to figure out whether the spike in oil prices has anything to do with the underlying value of a company. So, Kirill, why do these prices spike suddenly? I mean, you would think that prices will drop, right? He's promising some more, drilling of oil, more refinery, so demand supply goes up, and if demand stays the same, then you would at least expect a price drop, right?
Yeah, I would say the situation with the oil industry more or less similar to gold. It's really news driven mainly, especially nowadays, because whenever something happens in the Middle East, I'm not gonna go into specific events, for example, or whatever, so that just to make sure that we can still have this video running without any restrictions. Usually, if something serious is happening, then the oil prices would also go up, primarily because of the fact that if something negative is happening in a certain region, then it means that probably the oil production is gonna be disturbed. The pipelines, the supply chains are gonna get disturbed. So that means that people, or for example, the companies, organizations that needed to run their businesses, they would rather, to avoid the risks, they would rather get more gasoline, oil, or so on and so forth, or any other additional products at this very moment, just to make sure that they can be safe throughout, all of these uncertainty situation. This applies to many cases. For example, what happened in Russia as well, now with Venezuela as well, because of course that's one of the, I think it's if I recall correctly, it's the biggest oil reserves out there in the world.
Yeah.
They have not per se the, I think it's called the hard oil. So this is a type of oil that needs like further refinement in order to be actually, let's say, consumed on a daily basis, on the, for the production purposes for the vehicles and stuff like that. But still, regardless, it's the biggest one, and whatever is happening right now, of course, might disturb the situation for a longer period of time. So that's
Yeah.
why the oil prices are going up, just
Yeah.
just to be super short on this one.
Yeah. Yeah, and then also there's a lot of geopolitical incentive as well, because yeah, Venezuela trades a lot with, for example, Russia, but also with China and with India. So for Trump, this is another way to have some leverage over these countries as well. So not a good situation, and hopefully the Venezuelan people will be, yeah, will have some better times ahead of them soon.
Because the worst part in all of that, if the oil prices go up, that's also gonna just affect the pocket of the average people across the world, because everything is gonna get more expensive, the logistics, production of certain things, and that of course is gonna be redistributed in terms of prices. So we are, as average Joes, Robs, Kirills, we're gonna be affected directly, sooner or later. It's just really a question of for how long this will be lasting, and many other cases. So yeah, it's just as a bottom line is still pretty interesting to look into the sector, especially if you know more than we do for specific companies per se. So that's why we're also thinking to look into the lovely Exxon Mobil example, just to have a bit of a gist in terms of how it's going there in the industry of the U.S. Oil companies.
Yeah. Exactly. And of course, Kirill, we're not here to speculate. We are a fact driven platform. So, Kirill, let's dive into the fundamentals.
Serious, sir. So yeah, we would go to our app 930. So what can we see? So of course, to start off, the oil, of course, going up. So that it means the stock price of ExxonMobil is also going quite high. It's already, congratulations! It's already hit all-time high, so it's good for the shareholders, me including, I guess. Quite happy about it, but doesn't matter. So if we go into the 930 score, we see a little bit of a different picture. So we do not really see any bright sunshine when it gets to the actual fundamentals. So the revenue growth, the cash flow growth, net income growth is quite moderate, I would say, and it also applies to the margins. The only thing that is really, of course, benefiting now is the stock price change part of the 930 score. Of course, we just discussed all of that, but that's really just a matter of the underlying, commodity price. So what we can pretty much say is that ExxonMobil in this case is not really primarily driven by the fundamentals per se. It's really just a question of what's the price of oil at a certain
Yeah.
period of time.
Which is also not something weird, right? If this is your driving product uh, for everything that you refine, basically.
Yeah.
So if we dive into it, we can see a P ratio of 14. Crew. I'm not really that well known with the oil industry anymore. I'm not sure whether that is representative of the industry. Either way, we can see some healthy margins, 22% operating margins at 12%. A good healthy dividend payout ratio, and a dividend yield of 3.2%, which looks nice. If we look at the company fundamentals over basically all the data that we have, we can see the average revenue growth of 2.94%. And of course, this has a lot of data. Exxon has been there for a long time, so there will be a lot of fluctuations in these numbers. The long term that is covered by free cash flow, albeit small. But again, this has been over all the years that they have been operating, or at least that we have the data of. They have been buying back shares at 2% on average per year, which is nice. Dividend growth of 4.5%. So at least they are really rewarding their shareholders. But then we are looking at the pain points of the net income growth and the free cash flow growth. Again, there have been some dips in the time that we have the data. Some major crises. So this is also not something that I should be shocked of. But I think we should look into how they have been performing in the past 5 years to really get a clear picture.
Yeah, and just to add up on all of that, I think if you're one of these people who are really into the dividend investing, that could be probably one of the good examples of a dividend stock. So high yield, payout ratio is still more or less on a moderate extent. The revenue of the dividend growth is still there. So and of course they also provide quite a decent share buyback rate as well. So it's you're not gonna look for growth in here apart from the fluctuations again in the oil prices. So if you just want to have like something like a safe haven for your money and just to get a bit of a dividend once in a while, that could be something interesting for you potentially.
Yep. All right, so let's look at the previous years. So we can see almost a really stable revenue from at least 2023 and onwards.
Yeah,
That's crazy,
true.
crazy stable.
Yeah, yeah, but yeah, and then you more or less have the same towards the pre-tax income. Um, what else? Net earnings, EPS. Again, but that's exactly what you said. Exxon has been there for ages. Uh, that would be quite surprising to have any huge fluctuations, especially in this market.
Yep.
They're playing really long games, so totally
Yeah,
makes
exactly.
sense. Totally makes sense.
I mean, it's one hell of a behemoth of a company, and given that, of course, there are noises of the world going to EV, there's still a lot of question marks with, for example, the whole infrastructure for that kind of change. So we will still have a lot of oil for the coming years to see.
Yeah.
So it's also not it's not that it's not relevant. It's just not doing as much. It's just really stable. It's already big as it is.
We can say at least in terms of the environmentally friendliness part of things, of course, it's getting better because nowadays I think I was checking the statistics on the use of different sources of energy, and oil and I think coal is finally going towards a decline, and the renewables are actually going quite increasing quite sharply in the past years, which is good. Maybe Robin later you can have a look, maybe find the reference what I'm talking about. But yeah, it's still gonna be there as you say for at least quite a few years. We just don't know when the change will happen, but it's already happening. So that's also a good thing.
Yep.
Um,
Great. So maybe let's go to the ratios.
Yeah, just maybe quickly apart before we go to ratios. I think the only thing which is important to say is about the long-term debt, which is again more or less the same story that has been happening to the other companies we've been looking into. They loaded up on long-term debt during COVID, cheap debt. They got into it. They're gradually paying it back, which is nice, but still something important to keep in mind. The company has some debt burden. They're able to cover it up, but you always need to keep an eye on these kind of things. So if they need more debt, but their, let's say, bottom line is keep on getting worse and worse in terms of free cash flow, in terms of net income, so on and so forth, be mindful of that, because then it would also most likely mean that if you get this stock for just for dividends or for share buybacks, this is the first thing they'll cut. So be mindful of that. Be careful.
Yeah. Also, I found your source on Ember
Mm-hmm.
that indeed renewables have surpassed coal in global electricity.
It's on the
That's
coal. Okay.
electricity generation, and same goes for gas, but oil is not in the list. It's
Okay. Okay.
yeah.
Okay. My bad. My bad. I'm just trying to paint the picture I wish would be happening, but maybe one day. One day.
Hopefully.
Yes.
All right. Yeah. So for the ratios, so net earnings are not really where we normally would like to see,
Yeah.
especially long living behemoths and cash cows. I mean, normally we would appreciate a company around 20%, 15% net earnings ratio.
Yep.
This is a bit on the low side, and I wonder where all their money goes to.
it's expensive, right? It's
Hmm.
manufacturing, it's all the logistics, it's
Yep.
all the processing of
Yep.
oil and natural gas. So you cannot have such great margins as Google
Yep.
enjoys, Microsoft, Apple, whatever. So it's, to be honest, totally sensible, and that's also something that you guys have to make your peace with if you plan to invest in it. Do not expect crazy growth. Um, in a realistic scenario. I know things can happen. Certain presidents of certain countries decide to take emergency vacations all of a sudden. That's something you cannot account for, especially in the case of Venezuela. But in a realistic scenario, it's really hard to imagine that the company would really start growing its revenue unless they start diversifying further, for example, into the renewables. That could potentially drive the revenue further, but in the core
Yeah.
business, no, not really.
Yeah. And 2020 has been a real difficult year for Exxon, of course, with COVID and all.
Yeah, but
Uh,
but then after that,
yeah.
2021,
Yeah. Yeah.
then it got
Exactly.
back to the good parts. But yeah, it's if you're looking to trade this one, it's just really a matter of just looking into the news, looking into the the context of the what's going on politically speaking and stuff like that. So
Yeah. Um. Yeah. Just a really up and down company compared to what we normally, oh, we you let's say used to.
yeah,
The gross margins are actually quite decent, averaging at 25% ish. Yeah.
yeah. Again, more or less on average to the market, a little bit below than that, but yeah, it's like I feel like this stock, probably also including chevrons, it's like more or less a more risky version of you putting money in the savings account. It's just
Yeah.
giving a bit of a return. It has some fluctuations. Let's say, of course, it's way riskier than than that, but over the long run, it's just gonna return you a bit of a dividends, a bit of a return on the stock appreciation, but that's probably about it.
Yeah. All right. Well, let's go into, of course, the main event, the valuation.
Yes, I think it would be super fun, Robin. In the meantime, you look at our lovely friends at Yahoo Finance, what
Yeah.
they say, what's gonna happen to Exxon in the upcoming year. I'm really curious in terms of what
I
they're.
think it's probably rainbows and unicorns and sunshine, and it's gonna be the best.
Yeah, it's
It's the best.
it's pretty fresh news, of course, so they might not have updated their forecasts yet or provisions. But okay, while Robin is doing it, I'm just gonna proceed to filling in the valuations.
Oh,
Yeah.
it's bleak, but again, it's,
Oh.
yeah, like you said, how we don't know how it's how the current news is not really valued in yet. As at least it is probably at this point, but more to the fact that they did not update their analysis yet. But they are saying that the current year is -10%,
Mm.
and they are proposing a growth of 0.6% next year.
Mm-hmm.
So that's what I'm saying. Very bleak.
Yeah.
Probably they already accounted for some downward trends with oil consumption, maybe what we talked about. But if we are looking at their earning per share estimates and what they have been beating the analyst um, consistently.
Mm-hmm. Mm. Yeah, but that's what usually is happening. So the beating the expectations is rather a surprise when it gets to some really inconsistent companies, But with Exxon, with Chevron, with any other oil company, I think it would be quite really something out of the proportion. Something weird has to happen
Yeah.
for that.
Mhm.
Anyways,
All right.
yeah.
Yeah, let's go into it. So, yeah, I'd suggest let's keep the assumptions based on the last 3, maybe 5 years. The Yeah, it's kind of just, yeah,
It's pretty low, to be
it's
honest.
pretty low.
So,
Yeah.
mm,
Well, at least just let's let's go with the flow. We'll see
Yeah, yeah,
where
yeah,
we end up.
yeah.
So for the projection period, yeah, I mean, let's do. I think 5 years. It's super difficult. I think with these kind of companies to really look ahead that far into supply and demand, especially considering, of course, the fluctuations with just oil prices and the global demand for that. So
Well, let's put it like that. Will it go anywhere in 15 years? Don't think so.
probably not.
Yeah, the only thing what you say, which is correct, how sharply the demand would decline for oil products. But also
Mhm.
keep in mind that Exxon is not only oil; they also provide natural gas, and also consider the fact that, for example, in the Western Hemisphere, in the developed countries, they would probably shift towards the renewables quicker. But you still have a lot of demand coming from more rural areas, from
Mhm.
let's say from Africa, from Asia, or Middle East is fully based on it. Russia as well. So um, there would still be demand for oil regardless because it's more sustainable source of energy in the remote areas. You know what I
Yeah.
mean?
No, of course.
So
Now it's just a matter of if we are putting in 15 years, then how well is the estimated growth rate that we're gonna put in there
good point.
be valid?
Good point. Yeah, I think I agree with you. Let's stick with 5, and then we see how where we end up.
Yeah. Yeah. So for the discount rate, we normally take 10%, and we will do this as well. If, of course, if you want to try the app yourself, and we'll get into it later. But if you want to try it yourself, you can play around with these numbers. If you, yeah, want to put in different assumptions than we do, then go ahead. You might have some other knowledge than we do. That's also why we are saying this is just for educational purposes. For the estimated growth rate, Kirill, we are seeing 5 years the growth rate of an average. We can go back. So what's that? It's like 7% per year, and this is something really negative. If you take the average of the free cash flow and revenue growth, I'm not sure in this case, Kirill, what would you expect to be more of an accurate denominator here? Would it be the revenue growth or the free cash flow growth?
They usually go hand in hand. The question with the free cash flow growth, of course, lies within, for example, their expenses they need to incur to drill more and to, of course, process more products. So, for example, they would need to find the new sources of it, right? Maybe buy some of the land that still has a lot of oil or natural gas reserves, for example. So it's really just a question probably to look into to that. So what kind of areas Exxon is drilling on? Of course, it's really crazy. So many. It's the biggest one, and in terms of their areas of operation, they're huge. But probably also good to look into that. I think we're also having some more discussion about Occidental.
Yep.
What was it? Several months ago.
Mhm.
That would be important. But I would say no more than 2% growth rate, just to be, let's say, just expecting the normal case scenario, right? Because again, it's all about the estimates, it's all about the assumptions. So it's probably gonna have more hit on the bottom line, but then again, it's really just a question of what would be the prices of oil in the upcoming 5 years, and the answer is we have no clue. We have no clue unless you have some special, as a viewer, you maybe have some special knowledge about it, some insider understanding about the company, about its operations, or about the whole market. You know, you can probably make some great bucks on it. As for us, we're the average Joe. It's hard to predict that.
Yeah, I can just quickly look into what they are expecting. So between 2025 and 2035, 24, they expect oil price to average on $65 per barrel.
Mm-hmm.
So yeah,
Yeah, you cannot really do anything about it. This
no,
information, you know.
it's yeah, it's they don't give percentages much, do they?
Yeah, you can go to a
Uh,
casino and you probably would have better odds, hitting a jackpot versus trying to predict this. So, but anyways,
yeah.
let's put it like that. Not to waste time, let's put 2%. Let's just stick with the PE, the average PE. We're talking about between
12.
14 to 8. So sure, let's do 12. I mean, it's small numbers, anyways. Required rate of return, Rob. Stage is
Yeah,
yours.
of course. If you're investing in ETFs or in index funds, you are expected to make a return between 7 and 10% annually, historically speaking. Because you're stock picking, you have a bit more um, risk attached to it, right? So therefore, you want to have a bit of a premium on what you make. So we normally do this between 10 and 12% to be more on the realistic side of things. But of course, you can also, if you have a more riskier bet, or maybe oil is a really risky bet, you can also, of course, up the return that you want. This will also decrease the price, basically, of what it should be worth, and also when you should jump on the stock. But normally we do it between 10 and 12%. So crew, go ahead. For the margin of safety, this is basically up to you. There are a couple of things at play here. How much risk tolerance do you have? How much do you know about the industry? How much do you know about the company? What's your age? So, for example, if you're older, you might want to have a higher margin of safety because you don't want to lose all your money on one or a couple of bets, right? But when you're younger, you have a bit more risk tolerance because you have that much more time to make up for some of the losses that you make early. But also, for example, if you don't have no of knowledge about oil, so for example, I don't have any knowledge about the whole industry. I would even go as far as putting 40 to 50% until I've really fully read myself into, for example, Exxon or the oil industry. Kirill, I leave this one up to you. I know that you're a bit more familiar with oil than I am, so
I would say I'm on the same case with you. I'm not really into the industry. It's more like, again, a bet. I have like three companies in the industry. So I have Chevron, I have Exxon, and I have Occidental. But it's really smaller parts of my portfolio. So it's a bit of a dividend income, a bit of just buying and selling here and there, but nothing too much. So that's what would probably also explain my margin of safety in here. So I would also put, let's say, 30% in this case. But then again, we can just discuss how it's going after we hit the analyze button. And what we see after we hit the analyze button is that the current price we're talking about is $124 US, and the average valuation of about 73. Good, interesting thing to see that the Warren Buffett's formula is quite close to the one of the target valuation, which is focusing on the PE and the EPS. Even considering the fact that our growth assumptions and the number of years are quite low. So,
exactly.
with the discount cash flow formula and PV, of course, there's nothing to talk about. There's no cash flow growth. There's no proper evaluation in terms of what you pay. Maybe what would be good eventually in the future is to also add a dividend discount model for these kind of stocks later on, because then you can also account for that perspective. So you base your price assumptions based on the dividends. So I would say, considering especially now that it's all-time high in terms of the price, if we'll look back up, it's pretty expensive. It's probably a little bit late to jump on that train, at least if we're talking about the short-term perspective. Yeah, in the long term, if you just really want to get your dividend stock just to diversify into the sector, could be potentially interesting idea. But I would also suggest you to look into the other companies in the field. So the biggest ones, Chevron, let's say Shell, etc., etc. Depending also what country you are living in, what kind of stocks are available for you to trade. So, just look around. But in terms of additional things, you cannot look for growth in here. You cannot really look for something that could generate you the quick returns, rather. So it's a long-term story. Yep. Which might potentially also end soon, considering all the renewables and change of a trend towards other sources of energy. So it's also something. Hmm.
Or of course, on the other side, at this point, you're in all-time high area. The sky's the limit. So you could also bet that way. But yeah, that's also, of course, we like I said, we don't really speculate on these type of companies. Like Real said, yeah, this is what in it from our perspective. But Real, where can the viewers go if they want to check their perspective?
Yes, very good question. And you guys can go to a nicer looking 930 website. We launched it, what was it, a couple of days ago. It's a full revamp. You can have a deep dive into the articles that we write. You can also see some of our latest videos in here. Of course, obviously, you can have a look and feel of our website and of our app. You can just click view demo. You can just look around for free. No credit cards, no charges required. And of course, if you would like to get all the functionalities in, so if you, for example, would like to also have access to the 930 score, the future updates, if you would like to have a watch list, the screener, and soon, hopefully, to be released portfolio tracker, you can also support us by either getting a starter pack or the fully accessible 930 advanced version. It's only €3 per month for now, because we're only more or less starting the thing, but we're also, of course, gonna change the pricing real soon, so make sure to lock in this price for you, and it's gonna stay like that forever.
Exactly. I have nothing more to say. So with that said, crew, thank you for your lovely insights. Thank you for watching, and we'll see you guys in the next video. Next week, by the way, we're back.
Yes, we are.